With the Bank of England having just set the base rate to 5%, which is the highest level seen for 15 years, the UK is potentially heading into what some are calling a mortgage time bomb, with millions of people potentially having to fork out thousands of pounds a year extra for their mortgage. Is this now the start of the crash that many people have been waiting for, or are we just in another part of the cycle where things just aren't as bad as they seem? Well, let's take a look at the data, run through lots of examples, and see what the hell's going on out there. So as you might have seen this week, Andrew Bailey, the Governor of the Bank of England, has taken action to raise interest rates to a new recent high of 5%, up 50 basis points from where it was before at 4.5%. Now, this wasn't a complete surprise that rates were going to move up. Many people had expected things to keep moving up slowly, but 50 basis points was a bit of a shock. The big rise was pretty much one of the only options left for the bank to pull, as just the day before, the latest CPI data got released from the ONS telling us that inflation in the UK is not going away. Unfortunately, prices in the UK are staying stubbornly high and aren't falling back to where the bank wants it, down around that 2% mark.
Look at this latest figure, it's level, but level at a really troubling number, 8.7%. The expectations were this number will be starting to fall down to 8.4%.
Now in the CPI data, which stands for Consumer Price Index, the figures released came in at 8.7%, which rather than falling as was hoped, stayed the same as the month before. All this means is that all of the pain that you're feeling with your bills right now or at the supermarket just aren't going away anytime soon. And unfortunately, it's not just your bills that are set to rise. Now, one of the biggest knock-on effects of the rise in interest rates is the rise in the cost of money. So basically, any loan out there with an interest rate attached to it, unless fixed in place already, is set to go up. And this includes the biggest cost to most households, our mortgages. And now here is where the potential ticking time bomb comes into play. You see, as we've all had these pretty low interest rates since the global financial crisis, the moment we have to remortgage or maybe even get a mortgage for the first time, we have to get ourselves onto today's rates. And as more and more people coming off their old low rate mortgages over the coming months are having to now settle for much higher rates, this is set to put some huge pressures on household budgets. So as you can see, here's how many households are set to remortgage over the coming year in total. Since the rising of interest rates by the Bank of England, which have now taken place 13 times in a row, around 2 million households have already had to get themselves onto new deals. But here's where the ticking time bomb comes in. Now, as you can see, between now and the end of the year, another 800,000 households need to get new deals. And then by the end of 2024, another 1.6 million deals need to be sorted. Probably many of you out there watching this video. Now, everyone will have a unique situation, so it's hard to give exact numbers as to what this might mean. But what we do know is a lot of households are going to have to come from deals which are somewhere less than 2% a year to deals which are likely going to be maybe even above 6%, and not everyone's going to be able to pay for that. Adding on more monthly cost to an already stretched family budget is going to hurt a lot of people. But the question is, what's the damage? Let's run some numbers. So credit to Honest Money for this useful spreadsheet I'm about to show you. I'll leave a link in the video in the description and you can even download this yourself. But let's just look at what all of this means in real terms, because I don't think this gets talked about enough. Now, this works the same for a new buyer or someone looking to remortgage, so don't get too bogged down looking at the deposit column. But let's just say that you have the average mortgage repayment in the UK right now, which apparently is around £737 a month. Assuming this is already in place at the lower rate of 2% or so, here's what the increase in interest rates will mean for your repayments as soon as you have to get a new fixed deal. If you've got a 3% deal, which would just be a pipe dream at this stage, you go to £836 or an £89 increase for the monthly payment. At 4%, you're now going to be at £930, just about to push into four figures with an increase from your old deal of now £183 a month. And just before we head into the other rates, that's a lot of money, and how many households can find a spare £200, let alone what we're going to look at now. Anyway, so here goes to 5% and above, which is more realistic, and now we're at £1,030, which is £283 more than from the original deal. 38% more expensive, which I doubt any kind of stress test would have ever assumed that you could have had to deal with. And now for the big ones. At 6%, we're at £1,136, and at 7%, you're at £1,246. At the top level, you'd have to pay almost £500 a month more in mortgage repayments from your original deal, and your total cost of your mortgage would be £373,710, which ends up more than doubling your borrowing if this stays this way for 25 years. Obviously, this is very bad for anyone, and also first-time buyers will end up having to either give up the dream of owning a home for longer or settle for something a lot cheaper. And sure, you could say that these rates won't last for a really long time, but even certain analysts think that we're likely not going to see a return to rates of the 4% level until around 2027. So maybe 3 years worth of paying an extra few £100s a month for already stretched households is not going to end well. Going back quickly to first-time buyers, remember that they make up around 50% of the whole buying market. So the moment that you start hurting their buying power, you could possibly cause a huge amount of pain, unless of course they can somehow stump up even more of a deposit from the bank of mum and dad. Just as a quick segue, if we do look at some of the best deals on the market today, as of the time I'm putting together this video, on the day of the interest rate rises, now for a 5-year fixed interest rate mortgage, here on Legal & Country Broker's website, we're looking at 4.39%, and then on the shorter term deal for 2 years, again on a fixed term, we're now looking at more than 5.23% or 5.27% from Santander and HSBC respectively. Now just bear in mind, this is assuming a 250k house with £150,000 left on the mortgage for a 25-year term. Definitely expect to pay a lot more if you're a first-time buyer or have a deposit a lot less. Anyway, what does this mean for house prices and what does this mean for the wider market? Let's quickly look at the latest figures, but do remember that we're always looking backwards here, so just be careful what you make of it. I did a similar video just a few months back when some of the cracks were starting to show, but overall I think the market stayed up a lot more than a lot of the doom and gloom merchants on YouTube wanted you to believe. Heading over to the latest Rightmove report released this month in June, here are a few takeaway points that they commented on. Firstly, a drop in asking prices finally, which apparently is the first time this has happened during a June period since 2017. They predict that asking prices will fall pretty much every month from here until the end of the year, with the overall outcome being a 2% drop. Now, one interesting point here is that even with all the turmoil in the interest rate market, they say that there's almost been no effect on buyer demand, but there has been a small decrease in the amount of sales agreed on. Now, quickly jumping into some of the rest of the report, here's always an interesting part. If we look at regional trends, you might be thinking to yourself, what crash? Almost everywhere is still up either month on month or year over year, with just a couple of regions showing some weakness in the month, and just the east of England being the only place with a drop over the year, but that's just 0.1%, which is virtually nothing. If you're interested, the strongest gains across the year so far are all found up north. The northeast leads the way with a 5.5% change in 12 months, followed by a joint second place with Scotland and the northwest of England hitting 3.6% for the year. And in terms of pricing, when you exclude the insanity of London and the south, you're seeing prices around that kind of £250,000 mark. How any first-time buyers get on the ladder down there without help is beyond me. Now, a quick look at affordability, because this is the biggest thing we should always pay attention to. There's two graphs here, but firstly, this one shows us how much people are paying a month versus renting. And as you can see, we're in silly territory now compared to the past. And since June 2022, the green line, so that's mortgage payers, has been detaching a lot more from what a typical renter's paying, that line below. You'd have to assume that these have to join up at some point again, so expect rents to keep going up and then of course prices to keep coming down as well. Now this chart secondly shows us more affordability information. We've got 3 lines. The bottom line is 4.5 times the average salary. Then the next one up is the average asking price. Then a key one I think is the top one, which is 2 average salaries combined. Now, as you can see, as much as we all complain about housing being too expensive and it has to come crashing down, as an average at least, if you do buy together with a partner, you are more than capable of buying a house if you can get 4.5 times your salary together. I think we sometimes forget that when talking prices and always just think of it in terms of one person. Now sure, if you have kids and only one person works, it becomes a lot harder, but it does explain why, at least for the time being, things are pretty stable. It does raise the question though that what the hell are you meant to do if you do want to raise a family with one income? That is seriously hard work. If we look at Nationwide's report just very briefly, they echo a similar message, but one really interesting thing worth pointing out there is where we are currently on mortgage approvals. So the latest numbers shows 52,000 approvals from May of 2023. Now it's still a shortfall compared to pre-pandemic levels, but then you do have to remember where we are with interest rates. So actually you could argue that things are holding up pretty well. Another thing worth saying here is that even with approvals at a low number, this doesn't mean that house prices have to go lower automatically, as it really all comes down to that fine balance of supply and demand. Now, I wonder how many people on the market right now maybe don't really have to move, but they're just looking and actually can do fine staying where they are. Likewise, how many sellers really have to move out, or could they also just put up with staying for a bit longer? I bet as well that many sellers have a number in their head what their house is worth, and if they don't get it, then they'll just ignore it and stay where they are. Also, a whole nother section may be worth covering in another video, but we're just not building anywhere near enough new homes for a growing population. So for now, we really are constrained by tight supplies too. So the big question then is, where do things go from here? Now, banks are apparently saying that only a small number of customers are experiencing financial difficulty or strain, falling behind on their mortgage repayments. As you might already know, the job market in the UK is still pretty tight, and wages have been rising, even if they haven't exactly been keeping up with inflation. Now, while some people clearly still have some cash saved up, there are many people who are suffering, and in the same article here, it says that Step Change, the debt charity, are showing 45% of mortgage borrowers having difficulty keeping up with bills. It goes on to say that Brits could be leaning on credit cards to keep themselves afloat, with 343 million credit card transactions taking place in March, which is 4.9% higher than just a year before. Then what about repossessions, the worst case scenario? Well, so far at least, looking at the latest information from UK Finance, 700 homes have been repossessed, which is up 15% year over year. Sounds pretty scary, but is that number high? Well, no, not really at all, and it's not even close to the rate seen before the pandemic in 2019. For some perspective, if you turn that 700 number into an annual one and call it 2,800 by multiplying it by 4, let's see how that compares to other times in history. As you can see here, by year, 2,800 is really low, and there's been many years where things have been a lot worse. I mean, just look at 2009 with 48,900 repossessions. Or maybe even a better comparison with high interest rates. What about 1991, where there were more than 75,000 repossessions? So look, obviously we've got no idea just yet how these new interest rates will affect people, but we do know it's going to cost them more. So either people will cut back on other spending, or they increase their mortgage term, or they'll even take a break for a few years. One thing we can't say for certain is that there's going to be some kind of sudden house price crash, when in reality, we just don't know, and every single regional market is just so different. So what do we do about all of this then? Well, one possible solution here is that the government steps in somehow, either offers some kind of help or even stops banks from taking houses from those who are just worse off in a similar way that it's done with the energy crisis. Or we see a quick change from the Bank of England and they reduce rates at the next meeting because the next inflation data comes down as they'd hope. On both of those things, we haven't got a clue what will happen, but all we can do is try and manage what's in our own control. And if you do have to remortgage soon, then the best thing you can do is hunt for deals as early as possible. Remember, you've got 6 months to do it, and you don't have to stick with your current provider. You might even want to fix for longer as well, so that's always an option. Now, personally with mine, I got pretty lucky just a few years ago. So in 2021, I managed to fix mine for 5 years because I kind of wanted that certainty with how much I'd have to pay each month. But then, of course, hindsight is 2020, and it's worked out pretty well. Now, either way, think carefully but act quickly, and don't leave things until the last minute. These issues could last for a long time, or we could see inflation finally start to come down as prices flow through the system. There's no way that it's sustainable for a super long time, and it's just part of the economic cycle, unfortunately, even if it could be managed a lot better. Now, over to you as always. I'd love to know in the comments what you think will happen. What's your mortgage like? Are you on the ladder at the moment, or are you wanting prices to drop to get your first house? And do let me know your predictions for house prices over the coming few months and this year. Do you really think that we're going to see 20% or more drop in the housing market, or all of these videos on YouTube just a load of clickbait trying to scare people for no good reason? Anyway, leave a like on the way out, subscribe for many more videos, and as always, happy investing.